just as a bit of review, and then we'll talk more about topic 7 in regards to this particular problem. First of all, remember the basics. Remember that all the accounts have an increase side and a decrease side. You need to know the different kinds of accounts and which side indicates an increase, which side indicates a decrease. Very simple example. On March 1, we made sales for cash. Cash is obviously involved, and cash goes up. We know that cash is an asset. Assets increase on the debit side. So in the debit column, we put 7850. We also know that we made a sale. Sales is a revenue account. Revenues increase on the credit side. So both accounts increase here. Cash debited, sales credited. They both increase. And then in the reference column, you see the accounts where we recorded this entry into the ledger. So same way in the second transaction and all the way through. So you need to know the different kinds of accounts, and you need to know increase and decrease sides. So that should be second nature to you by this point. Also remember, debits always equal credits. In the first few transactions, you see pretty obviously debits do equal credits. In a more complicated transaction down here on March 31st, the payroll entry. You see salary and expense debited by $25,000. You see 4 credits that you should have indicated. All of these liability accounts and cash would be credited. If you add up these 4, they should add up to $25,000. So debits do equal credits. Again, as a review, let's go back to the ledger at tabs at the bottom and look at cash. If you did this problem correctly, you should have a lot of entries into the cash account. Debit side would indicate all of the increases. The credit side would indicate all of the decreases. If you add up the debit side, you would come up with $118,778.50. If you add up all of the credits, you would come up with $42,403. Now, if you then subtract the credits from the debits, you end up with a balance, a debit balance in cash. There's more on the debit side than the credit side, so it has a debit balance of $76,375.50. In the ledger accounts I've shown you so far, you don't have a balance column. Very often there would be a running balance where you can see the current balance of the account, which means the difference between the debits and the credits in that particular account. We don't have that, but if we did, this account, cash, would have a debit balance at the end of the month of $76,375.50. And incidentally, that may be something you want to caution the owner about, because you started out the month with $112,000 and you end up with only $76,000. If this was the only thing that happened during the month, we lost a lot of cash, but we still have a debit balance. Same way in accounts receivable and inventory and so on. So all of these accounts would have balances found by subtracting debit from credit or credit from debit, whatever the kind of account. Now I want to go back to the journal and scroll down and take a look at the payment you should have made on March 31st. There should be a debit to federal income tax payable. The transaction way up here on March 31 says based on the amount shown in the account, the flower shop paid federal income tax. So federal income tax is debited by $18,300. Just to review, where did that come from? Well, if you look at the account, federal income tax payable, there were 3 credits. We have a monthly payroll in January, in February, and in March. You recorded that that entry in March. So those 3 have credit balances of $6,100. At the end of the first quarter, that's where we are now, March 31, you see a total, if you added those three up, of $18,300. That's where we came up with that amount of money. In the journal then, we debited $18,300. We credited cash because we're paying the money. So when you post that to a federal income tax payable, you debit the $18,300 from the journal, and you now have a balance. If you add the three credits and you look at the debit, they both equal $18,300. So we've paid the entire bill. Okay, so we handled that bit last topic. Now we will look at this account in the ledger, FICA tax payable. Your problem did not ask you to do anything with that account after you posted the entries to the journal. FICA tax payable was not paid, but now we're going to look at how that is handled. Once again, this is different. FICA encompasses Social Security and Medicare, and it is paid half by the employees and half by the employer. Now, these three credits to FICA tax payable represent the credits that were made with a payroll entry at the end of January, at the end of February, and at the end of March. So each time we credited $3,900. This represents the money we withheld from the employees. It's their money, but we have to pay it. In addition, we're going to have to pay our half. So if this represents their half, we have to pay our half. So let's go back to the journal and let's take a look at this account. Again, March 31, this was not part of your problem, but let's take a look at it now. You see that I have debited FICA tax expense by $11,700. Well, where did that come from? It came from FICA tax payable. If we went back to the liabilities and we added up these three amounts that we withheld from the employees, it ends up totaling $11,700. So if that's half, we have to pay our half, which is $11,700. So the first entry that an accountant has to make, there are two of them. The first one is a debit to FICA tax expense of $11,700, and we credit FICA tax payable because we owe that much money. So we credit $11,700. So I have the journal entry here. Let's post it. So we go to FICA tax expense. That's this account in the ledger. Let's put the date in. March 31, and the debit of $11,700 from that journal entry. And that came from journal page 4, and this is account 503. So we will go back to the journal and put in 503. And then we will go to FICA tax payable. We owe this much because this is our half of the FICA tax. So we credit $11,700 to FICA tax payable. So again, the date is again the 31st. And we credit $11,700. Journal page 4. You see now, these are from the employees, adding up to $11,700 at the end of the quarter. I don't do this every month. I do it just at the end of the quarter. I figure out how much the business would have to pay, which is the business half, $11,700. And this is account 205. And back here in the journal, 205. So that records the business part of it. Now, that was not part of your original problem, but this is something the accountant would have to know to do at the end of each quarter. Then, one last entry I had here already, again, the end of March. And now I'm going to pay the whole thing. I'm going to pay FICA tax payable of $23,400. And where did I get that? Again, back in FICA tax payable. If I add up all of this, it comes to $23,400. So if I want to pay the whole thing, that's what I have to pay, that total. So that's why back in the journal, I've debited $23,400, and I am paying it, so I credit cash, by the same amount, and check number 785. So I am paying the entire FICA tax payable. So this was 205, and in our liability account I have to record it, and it is a debit. 23,400 came from journal page 4. Okay, we've already put the 205 back in the journal. So we've paid the whole thing. We added all this up, came to 23,400. I paid it. Now the balance of this account, FICA tax payable, is 0. And I also have to go back to the journal, record the cash part of it. So I go to cash account, and I credit 23,400 because I paid the tax bill. Came from journal page 4, and it's account 101. So that is how that's recorded. As you see, the two additional entries we made in addition to the problem that you did was this one, which records the employer's part of FICA, the employer's half. So we added that into our ledger, and then we paid the whole thing. We paid the employees half and our business's half, and we spent 23,400 to do it. So a bit of review. Now let's look ahead a little bit. Let's talk about topic 7 just a little bit. Topic 7 is called Inventory and Cost of Goods Sold, and we'll be explaining that in some detail. But it deals with this entry and it deals with this entry. So when we make sales, when we've done this many times in the past, if you make cash sales, we did a simple debit to cash and a credit to sales. They both increased. If the customers charged it, they owe us more, debit to accounts receivable, credit to sales. What we didn't deal with is another asset account. If we go to this asset part of the ledger and we look at this account, there's an inventory account. So this is a flower shop. The inventory would be the flowers. We had that much, $98.60 at the end of February, and we bought a little bit more. So it stands to reason that if we made sales on the 4th of March and back on the 1st of March, that impacted inventory. But these transactions or these entries don't show that. So that's what topic 7 is about. We have to deal somehow with inventory with this. How does this affect inventory and how do we record that? That's what topic 7 will deal with. It's similar to what we did with the salaries. At the beginning, we debited salaries expense and credit to cash, and eventually we got much more complicated when we added in all the taxes. So we'll do that kind of thing in topic 7 with sales and inventory. Topic 8 will be the last one we do in the course, and topic 8 will deal with this kind of account. If we go back to our assets, we bought a delivery truck. Remember that? In your problem, we bought a delivery truck for $50,000, and I think we took a loan out for $40,000, paid $10,000 cash. But the delivery truck, as of March 17th, is valued at $50,000. Now, probably most of you understand the concept of depreciation when it comes to cars, and trucks for that matter. If you own a vehicle for any amount of time, it depreciates, which means it declines in value. So if I buy a delivery truck on March 17, 2018 for $50,000, 5 years from now, it's not going to be worth $50,000. It depreciates, it loses value. But this doesn't show that here. We need to find out how that is handled next year, in the year after, in the year after. Usually there's an annual depreciation that we have to account for somehow. So that's what topic 8 will be about. At this point, go back to your course page and answer the questions I have following this video.